Welcome back to the Pique Your Interest podcast. I'm Tim Malauskis at First Home Mortgage.
I'm Tanner with the Greenwalt team at First Home Mortgage.
And we are here to bring you an episode today about interest rates. As you might imagine, as people involved in the mortgage industry, we get a lot of questions about interest rates. Hey, what are rates? Where are rates going? Where have rates been? What do you think the future looks like? Is now the time to lock in? All these, kinds of questions. And it makes sense, right? Like that's a big component of what your mortgage payment's going to be. So we want to make sure that we're bringing you some information that you might be able to find valuable.
Sounds good. So we have a couple questions that we have picked out that we think are pretty important to, touch on when it comes to interest rates. So we're going to ask each other questions and then answer them for you all. So Tim, I'm going to ask you a question about rates.
All right.
Okay, Tim. So what are some of the common misconceptions about interest rates?
I would say probably the biggest misconception is that there is, the rate. Because years ago there were published rates, and that's basically the rate that everybody got unless you wanted to buy it down or something like that. It's not like that anymore. You need to take things into account. What kind of loan program is it? What's the credit score? What's the down payment amount? Sometimes things like your income and debt to income ratio get into it, but we'll get into that at another question. But I think one of the bigger misconceptions is that there is the rate, and there really isn't the rate. It's a wide range of interest rates that consumers might be seeing. The one difference would be, for down payment assistance programs, like, we're in Maryland, so we do a lot of the Maryland mortgage program. Everybody gets the same rate with the Maryland mortgage program. There is no buying down the rate. Your credit score doesn't affect what the rate is, just, which one of the programs you do qualify for. So I would say that's probably one of the bigger misconceptions, that there is the rate. Another misconception I think about interest rates is that, they're pretty static, and that's not the case at all. Interest rates move all the time. They're constantly moving. They have the ability to change every day. They even have the ability to change during the day. And I think that rates are a lot more dynamic and more, they're more moving than I think people think that it is. So there are times during the day where we'll get new interest rates 2 or 3 times every day. And, it's not the rate that we told you at 9:30 in the morning is not what the rate is at 3:30 in the afternoon. So, the fact that there isn't a rate that everybody gets, and there's also, rates changing all the time, I think those are probably 2 things that people don't know about interest rates.
Yeah, I was going to say, how often do you think a week that interest rates change? But they change daily.
It's every day. Every day it has the ability to be different, and even during the day it does. So you probably see rates change 5, 6, 7 times a week, something like that. And it's not uncommon for it to be more than that.
Yeah, agreed.
Yeah.
Agreed.
All right. So Tanner, here's a question for you.
Let's go.
How do mortgage rates for second homes and investment properties compare to the mortgage rate for a primary residence?
So primary residents are treated a little bit differently than like second homes or investment properties. I would think one of the biggest reasons would be for like the risk factor of the lender. So if you're a primary residence and it's your first home, you're not carrying, most people aren't carrying a massive amount of debt that they're bringing to the table, and we're qualifying them. But, if you're purchasing a second home or an investment property, you probably own a home already, because you're purchasing the second home or the investment either for yourself or a rental or whatever. So the interest rates are going to reflect on that a little bit. So, the higher credit score that you have, and typically the more money you're putting down on like second home and investment properties, it does help your interest rate a little bit. But that's why they're a little bit more riskier if you're purchasing a second home or an investment property versus a primary residence.
Good answer. I'd say, it's only been over the last couple of years that we've seen second homes treated more like investment properties than primary residences in years past. A secondary home, something you're going to buy in like Ocean City, Maryland, would have been not much more expensive than a primary residence. But over the last couple of years, that's sort of changed as Fannie Mae and Freddie Mac have sort of switched to first-time home buyers, primary residences, low to moderate income buyers, helping that segment of the home buying population. I think it's made second homes a little more expensive, more like investment properties to purchase.
Yeah. Also the market. Your economy is huge in our interest rates and what they are. So always watch what the news is doing and how the market's shifting based off the news.
Exactly.
All right, so let's see. Tell us about locking and floating in your interest rate.
Okay. Going back to the first question, a misconception is, when do you lock in? I think a lot of people think when you talk to a lender for the first time, you have the ability to lock into an interest rate. And that's, for the most part, across the board, that's not something that most mortgage lenders do. So you usually have the ability to lock in after you're under contract, right? Once you have a signed contract by all parties, then you have the ability to lock in an interest rate. You don't have to lock in if you don't want to. I mean, if someone advises you or you strongly feel that the market's going to get better and rates are going to improve, you may not want to lock in at that point. But, assuming you do have the ability to lock in at that point. And so you just need to make sure you're working with someone who knows what they're talking about, sort of, follow financial news, figure out what the projection for rates are. The beginning of this year, we thought we were going to see 5 or 6 rate cuts by the Fed. Here we are in April. We haven't seen any, and it doesn't look like we're going to have any before June, and even June seems questionable. So I think we've scaled back from 5 or 6 to maybe a max of 3. So it's always changing. It's never the same. And so as things evolve, you just need to make sure you're either staying involved with, in touch with what's going on, talking to people that know what's going on, people like us who pay attention to the market every day. And just sort of see what direction rates are going. How long do you need to lock in? Maybe you wrote a longer contract and you don't want to lock in because you think rates are going to get better in the, next 30, 45, 60 days, whatever the case is. Just being educated and staying on top of where things are going helps you make a better decision, I think.
Why do you think, I'm adding in a question, why do you think that floating your interest rate in this market would be a little bit riskier than not?
I would say, specifically now, as we're in April 2024, it's a risky thing, or it could be a risky decision that you make because we honestly don't know where interest rates are going. And, even today, as of the day that we're recording this podcast, the jobs numbers came in a lot stronger than we thought it was going to, 50% more than what we thought. Actually, probably 55 or 60% more than we thought. And that's pretty significant. And so when we're in an economy where we want to see interest rates go down, but in order for interest rates to go down, we need to see some sort of struggle in the economy and we're still creating jobs, that's not the message that the Fed wants to hear. And so I don't think, right now in the very short term, locking in might be the safe bet because over the last 10 business days, I think interest rates have gotten worse, 7 or 8 of them. And so it may not make sense to float at this point. It might make sense to lock.
Yeah, I agree. Yeah.
Tanner.
Yes.
How can a first-time homebuyer navigate mortgage rates in this ever-evolving mortgage market?
So obviously following the market trends. That means watching the news, reading the articles, picking up the newspaper, seeing what's happening out in the world. That's going to help you figure out where rates are going to be staying, or I guess at this point. Knowing where you stand credit-wise is very important because that dictates which loan type that you're probably going to be going through. So, lower credit scores go through FHA. Higher credit scores typically are able to go conventional. And going through the different loan types, that dictates which rate you're going to be getting or which your pricing is going to be kind of thing. Another thing to kind of note on is down payment assistance options. A lot of these programs out there, specifically the Maryland Mortgage Program, they designate their interest rate. So we as lenders don't have a say in changing it. You can't buy it down. You can't do anything to change it. Whatever they set it at on the day, they set it at. And we get an email, usually daily, every business day, that kind of breaks down each program that the Maryland Mortgage Program has and what their rate is, in conjunction with whatever loan type they're using. So I think understanding programs, understanding your credit score, understanding what's going on in the world, I think that's really helpful in figuring out where the rates kind of stand. So
yeah, totally. And I would add that speaking of credit score, one of the things that, a lot of loan officers participate with is credit rescoring, right? So you take a look at somebody's credit score and it's either borderline or, there's room for improvement. And so there are steps that you could take, whether it's, paying off a debt or paying down a debt, or there's something that is on your credit report that shouldn't be, an authorized user account, something like that, paying off a collection. Just, there are steps that you can take to improve your credit. And when you do that, you can sometimes move from, not qualifying to qualifying, or qualifying for one type of mortgage to qualifying for a better type of mortgage with a better credit score. So credit rescoring is definitely something that you should look into if you're looking to get the best rate, the best loan program, the least amount of money out of pocket, all that sort of stuff. The higher your credit score is, the more likely you see something like that. And credit rescore is one of the ways you can achieve that.
Yeah, so get your credit right, people. All right, Tim, so what features of the loan affect your mortgage rate?
Yeah, so we kind of touched on that a little while ago. First of all, the loan program that you use, whether it's a conventional versus a government versus a jumbo versus a bond program, like a Maryland mortgage program type thing. Different loan types have different interest rates, and the things that go along with that are like, what is your down payment? Obviously, if you put more down, you're perceived as less of a risk to the lender. And so your interest rate is priced a little bit better because you're not as risky. Credit score, we've talked about that a few times today. Credit score definitely plays into that. And obviously, the better your credit, the less of a risk you're perceived to be. So the more, the better credit you have, the more money you put down, more likely the more favorable terms you're going to be looking at. So it's a lot of those. And there are some programs out there where like income will play a part into whether or not you qualify. Fannie Mae has a Home Ready product. Freddie Mac has the Home Possible product. There are income limits on that. Even some first-time homebuyer, down payment assistance programs have, some kind of income limit. So sometimes your income, like exactly what that income is, comes into play. And there are certain restrictions for like debt to income ratio. So, you may be eligible for one product, but not for another because of what your monthly debt load is. So all of those things factor into, what your rate is, because a lot of that dictates what kind of loan product you're going to use.
Agreed.
All right. And Tanner, final question of the day. And this is probably not something that we get a whole lot right now, but it's definitely stuff we've talked about in the past. And I think it's coming down the pike eventually as rates fall. But can I refinance out of my mortgage rate in the future if interest rates go lower?
Yeah. So you can refinance out of your interest rate. Obviously, that's when rates do go down, like you just said. So if they're stagnant and they're not doing anything, then refinancing might not be your best option, obviously. But it also depends, on your loan type, how many payments you've made on your mortgage, things like that. You are able to refinance. Different loan types, like for instance, FHA, I think it's 211 days after your first mortgage
payment due date.
So FHA, if you're going FHA, this is an example. Yeah, after your first mortgage payment, if it's been 211 days, you're able to refinance. Again, assuming that the interest rates, are favorable to you. But yeah.
Yeah. It doesn't always make sense to refinance. And that's why you talk to people like us, right? Like it doesn't always make sense because there's a cost associated with refinancing. And so you will save monthly by refinancing in the most part. But, are you going to be there long enough to recoup the money that you pay up front for a refinance? That's not always the case. And so if you're not going to be there long enough, then somebody like us can tell you, hey, that's not in your best interest right now. I don't think that's something you should be doing. But if you're going to be in your house for a few years or hold on to that mortgage for a few years and save a bunch of money while you do it, it's certainly worth looking into at the right time. And, good loan officers pay attention to where rates are and who, what clients have what interest rate and when it might make sense to refinance them.
Yeah. It's also important to kind of note your equity in your home too. If you've got equity in your home, you have, or you've done like upgrades in the house, having equity in your home and then wanting to refinance down the line, that could help, set your monthly payment even lesser than it is now,
Yeah, totally agree with that.
Gives you a competitive interest rate then.
Yeah, absolutely.
Yeah.
So these are the questions that we get a lot about interest rates. There's certainly others out there. If there's anything that you have questions about, certainly feel free to call us, reach out to us and let us know. Hope you found this information valuable, and we'll see you guys later. Bye.